Welcome everybody to the May Income Plus Fund webinar. I'm Michael Episcope, co-CEO of Origin Investments. If you are an existing investor, thank you and welcome back. If you're a prospective investor, welcome and thank you for joining us today. Joining me today is David Welk, Managing Director of Acquisitions. He is a regular co-host on this webinar, and he is joining us from Charlotte today, and he is our boots on the ground. Dave leads our acquisition team, and he brings a lot of insight into the entire investment process and is always a great host. So Dave and I have known each other, gosh, almost 15 years now. We went to graduate school, and we actually used to do presentations together back in the DePaul Real Estate Center back in the day. So it's always fun to have you on, Dave. Welcome.
Thank you, Michael. Great to be here with y'all.
The webinar today, we're going to budget a little bit more time than usual. Normally we have about an hour. This will be about an hour and 10 minutes. We want to leave enough time for Q&A. For the first 45 minutes, Dave and I are going to be covering state of the market, fund performance, and then go over a few of the portfolio deals and give you some guidance as well on how the fund is performing and will perform. And then again, we're going to answer any questions with the time remaining. I do want to clarify the purpose of this webinar. We got a lot of questions early on, kind of basic questions. Tell us about Origin, tell us about, the fund fees and things like that. This is a fund update, and it's meant to provide a snapshot of past performance, current status, provide guidance, insight into the markets. So we're not going to go through any of the details about Origin, the fund strategy, fees, or items like minimums in the fund. You can find all of those on our website if you're not familiar with Origin already. You will benefit from listening to this webinar today. We do talk about the fund strategy and certainly a lot about the portfolio, but that basic information can be found on our website. I will give a little bit of brief background about the fund, just as a little reminder and level set here. The Income Plus Fund's primary purpose is to deliver a stable and tax efficient 9 to 11% total annual return, and this includes both income and appreciation. It operates as an open-ended multi-strategy fund that builds, buys, and lends to multifamily properties in growth cities around the United States. And the open-ended means that we are always taking capital into the fund. You can invest today, you'll be able to add more in the future as well. But one thing we don't do is, this is not a buy, fix, and sell fund. This is actually a buy, fix, and hold fund. We don't flip assets in this fund at all. And the reason is because we've really changed our strategy about being more mindful about taxes, building wealth. And you build wealth by buying quality real estate and holding it for the long term. That's true about a lot of assets out there, whether you're talking about real estate or stocks or other assets as well. They appreciate over time, and the upside is unlimited. And this strategy, buying, fixing, holding, building value, it maximizes appreciation and minimizes taxes, both of which are required to build real wealth. And that was sort of the genesis and the design around this fund. The fund is defensively positioned today, and we're going to discuss why we will continue to grow even in today's environment. Let me jump into the presentation now, and I'm going to start with the state of the market. And this part of the presentation could easily be an hour and a half. I've been doing tours around the country, just meeting with investors, and we talk about the state of the market, and some of these conversations last 2 hours. So I'm going to just abbreviate this and give you the cliff notes right now, because I know many of you see storm clouds on the horizon and are concerned, and we are too. And I know that based on what we're hearing at these luncheons. I also know that based on the questions that were emailed in. And whether those storm clouds dissipate, produce a small sprinkle, or a violent storm is up for debate. What I do want to say is that when it comes to real estate, this is not 2008 all over again. It's not even close. This is not going to be a real estate-led recession. The debt markets are behaving. The equity markets are a little frothy out there, but we don't see nearly the same fundamentals that set us up, in kind of that 2005, 6, or 7. The irrational exuberance does not exist in the market today. I'm going to jump to the second slide here now and really go deep into interest rates, because we got a lot of questions related to this particular metric. And so what you see in front of you on the right-hand side, this slide covers the last 8 months of the interest rate movement. And you can see how violent it's been, and interest rates have pretty much doubled in that time period. Where this hurts the most in real estate is in financing costs, first of all. Cost of debt becomes more expensive. 6 months ago, we could borrow at 3%. Today, borrowing costs are around 4%. And where this impacts the most is in our common equity portfolio. These are the stabilized assets in the fund. At least you would think this is where the part of the portfolio that's most susceptible to rising rates, but it's actually really well insulated. And the first reason is because it makes up less than 25% of the entire fund. So it's actually a very small piece of the fund. Secondly, 2 of the 3 common equity assets have fixed rate debt. And one of the properties, the property in Austin, it has fixed rate debt with a maturity that's out 35 years. So the risk to higher interest rates in this environment, and even maturity risk, has been substantially mitigated on 2 of the 3 assets that we have in that part of the portfolio, that portion. Where rising rates do have an impact is on new assets being added to the fund. And where new assets are being added to the fund is in our ground up development sleeve. We're actually not adding core plus or value add assets in this fund today. We just don't think that's a good bet, buying 3.5 caps, borrowing at 4%. We do believe that the market is a little frothy out there, and the only way to play this market is through ground up development. And the sleeve in here, as a reminder, we are allowed to deploy 20% of the fund's equity into ground up development. And that's kind of where we are, right around 18, 19% allocated to those projects. And those projects are financed with floating rate debt because you can't lock in fixed rate debt until you stabilize. Now, there are 2 ways in which we mitigate interest rate risk with respect to this portion of the portfolio. The first is by building value, by building cash flow. We're developing to a cap rate in the future of between 5.2 and 5.5%. So a property that's built for $60 million, let's say right around there, that's going to produce net operating income around $3.2 million. And that produces more than enough debt service coverage, actually about double when we're completed. So if you think about a project like that requires about $40 million of debt on it, at 4%, that's going to be $1.6 million. Well, when your property is producing $3.2 million in NOI, you're able to service debt and provide a lot of cash flow. And even if your numbers don't come in quite perfectly, if you're actually at a 4.5% or a 4% in something like that, even at a 4%, if the market comes down 4% return on cost, the cap rate in the future, you're still producing $2.4 million in net operating income against a $1.4 million debt expense. So by building that value, we're actually mitigating risk and the impact against rising interest rates as well. And that's the first way that you do it, is really by creating more cash flow at the asset level. The other way that we've done it and really helped this portfolio out is that back in January, we put a hedge on, and we hedge roughly $600 million worth of debt across all of our funds. We have more than $1.5 billion of development going on between our QZ funds, our Growth Fund 4, and this fund. And we entered into a swaptions contract with multiple banks when the 10-year was trading right around 1.7%. And a swaptions contract, I'll just kind of give you the basics, but it essentially makes money when rates go up and declines when rates go lower or stay the same. So when we put that on at 1.7% and rates went up to 3% or above 3%, it worked in our favor and worked very well. Now, we exited the position about 10 days ago because what I just said, you lose by staying in a swaptions contract if rates go nowhere or they don't continue to go up. There's actually a decay in the swaption. So we were in this only 4 months. We never expected an interest rate this move this quickly. And so we exited the position to profit. And we had a $15 million outlay that turned into a $24 million profit across all of our funds. And that was in a short span of about 4 months. The Income Plus Fund was allocated around $2.5 million of that profit, and that was done based on the fund's exposure to floating rate interest rates. We didn't hedge our entire portfolio, but we hedged a little more, call it about 40% of the ground up development that was in process at that time. And what that is, that becomes a small war chest that offsets the cost of higher debt in the next few years, and it's an asset to the fund. So the hedge worked really well. And the other thing that I think you need, like within this fund, rising rates are not bad for everybody. They are actually great for lenders, and a big strategy within this fund is lending. We are a big lender in this fund. More than 60% of the fund is either in or committed to preferred equity. And for those of you who have been with us for a long time, you'll remember even going back to March, April, May of 2020, we said, this is how we are positioning this fund to be defensive in nature. We are going to allocate more towards preferred equity because we just didn't see that buying existing properties at 20, 30, 50% of replacement cost made sense. And so that's where we are today, where 60% of the fund is in preferred equity. This is a protected position. It provides yield, and more importantly, a lot of stability. And you're going to see that later on when I go through a stress test and I show you the base case, a stress test, and an upside scenario. The variance just isn't that wide. Now, rising rates in terms of how they've benefited us in preferred equity, number one, that position in the fund has benefited because of the stability, but preferred equity rates 6 months ago were in the 11 to 11.5 range. Today, they're in 12 to 12.5%, right around there, and still well protected because the fundamentals of real estate are strong. And that's 850 to 900 basis points over current treasuries. So we're getting paid a lot. We're getting paid outsized returns for the risk we're taking in these assets. And so, overall, I think we've got more questions about these rising rates, and we've been able to mitigate their impact to this portfolio through both portfolio construction and then some of the fixing debt at the individual properties and then hedging it as well. So they've really, had a negligible impact on our returns because of some of the steps we've taken and how we've positioned the portfolio. And I'll just tell you, your money is not only safe, it's growing in this environment and will continue to do so. And the really, cool thing about how we've got this portfolio position, well, preferred equity is not a permanent piece of debt. So as these roll off in 60% of the portfolio today, well, as these mature, we can decide to allocate that money more into preferred equity and reallocate it into that, or start to change the nature of the portfolio if we see opportunities out there in the common equity space, if we think value add and core plus. So we know that we're going to have this future stream of income to take advantage of opportunities in the future. Let me go to the next slide because I want to talk about, a little bit about the housing fundamentals. I've gone over this before, but these are some of the tailwinds that are in the market. And we have been undersupplied in this market for nearly 10 years. And what we're seeing going on today is really a hangover from 2008. In 5, 6, 7, we were way oversupplied. It took several years to gobble up that supply and sort of create a balance. But the reality is today we are undersupplied. And I think one of the best examples I can give of what's happening in this market, Tom Briney, who's our managing director of acquisition, lives out in Denver. He was saying that in 2006, more than 500,000 people were employed in construction in Phoenix. Today, that number is less than 200,000. It's about 150,000 because, since 2008, so many people have permanently left this market. And today, the market needs around 500,000 units. We're delivering around 350,000 units per year. And because of the lack of labor, because of what's happening out there in these markets where there's so much demand, this is not going to be fixed in a year or two. There is still a lot of runway in front of us. The other thing that's happening in the market, and everybody's seen this, is that there's a permanent demographic shift that is taking place. It has taken place. It's going to continue to take place in our target markets. And yes, we've seen rents, go up by double digits. And yes, we believe there is still room to run in this market. We've seen what we consider wave one of the work from home movement and the flight to lifestyle cities. And like it or not, remote work is here to stay. I love an office. We love an office. We love building a culture, but the world in which we live in today, we have to give people flexibility. And this is only going to continue. And in many ways, you want workers who are going to be happy. And if they're going to be happier in Florida, in Texas, and these other markets, then that's the place, personally, yet origin, where we're allowing them to move to. But think about the mental map that's going on in a lot of people's heads right now, because we've seen this big wave. But if you have the choice to move from New York to Florida, right, there's all reasons why you wouldn't want to move. But let's say you're just doing the math equation. And the first thing is there's no taxes in Florida. New York City is above 10%. So right away, you're going to save $10,000 to $50,000 per year in state taxes. You can move to Florida in almost any city and get a 2-bedroom for what a studio rents for in New York City. And even when you're done paying rent, you still have more discretionary income left over. And that is an equation that is happening around the world. And I think more and more people, we just had one of our team members move down to Nashville for this reason. We had a team member last year move down to Tampa. And also we had another team member who moved down to Austin, moved down to Miami, doing this in their head. And so they're essentially trading these high tax states that maybe aren't suited around lifestyle to these lower tax states that have more of a lifestyle vibe for them. And that's going to continue. It's been going on for 40 years. COVID accelerated, and it's here to stay. The other point I want to make on this slide is that higher interest rates are actually tailwinds for us as well. They impact financing costs for every would-be homeowner out there. You can see on the right-hand side, mortgage rates, they were at 3% 1 year ago, and they just hit 5% this month. Well, mortgage applications have cratered as a result. And what you get as a result of higher interest rates and homes that aren't affordable, because as much as real estate apartment costs have gone up, so have home costs. And you have millions of trapped renters out there as a result of this. And this is really creating this perfect storm for real estate. It's creating this demand because these would-be homeowners, they're forced to rent, to stay in apartments today. And so those two things, the fundamentals are still very favorable for residential. And those two things that I just named are really driving the tailwinds to this market. So I'm going to go to the next slide. This is the last slide I'm going to cover on state of the market. And this really in the past 36 months, I mentioned construction costs, but they've risen by about 40% over the last 3 years. So a property that cost $50 million to build in 2019 now costs around $70 million. Every single input to building cost has increased. Labor, steel, lumber, land, you name it, it has increased. So why does the math still work? Well, one reason, because the growth in revenue has outpaced the rise in the cost of construction. This is the great equalizer, growth of revenue. And I put a little math to this, and just to give you kind of an idea, for every $25 increase in rent per unit, the value of a 300-unit property increases by a little more than $2 million. And that's a linear equation. So if you get an extra $50 per unit per month, the value is going to increase by $4 million. So in order to make up that $20 million cost difference, you need about an extra $230 per unit per month. And I will tell you, Dave's going to talk about, kind of how the portfolio is performing a little bit, but every market we are in has risen well in excess of that. Some have risen by as much as $400, $500 per month. And that's why the math still works in real estate. And I'll give you a great example how quickly this market is moving. The fund invested in a deal in Jacksonville called Linden House. This was back in the fall, and this is a ground up development project. And I remember looking at it, and it's, you're looking at deals that every 6 months come in 10% more expensive or 5%. And it's really hard to get your arms around this because you have to believe in the math and the team and the return on cost. And I like the deal. but it felt expensive at the time. And I voted for it and everybody voted for it. And in doing the numbers, we felt like we were underwriting it conservatively. And it's hard. It's just hard not to be anchored by the past. You would love to get last year's prices today, but that's not how life works. You have to have a little bit of a vision and foresight and take some calculated risk. Well, the team went down there a few weeks ago and rents have gone up $200 per unit in just the last 6 months alone. So from the time we closed this deal to today, 6-7 months, right? 15 to 20 million dollars, right around there, of value creation has taken place on top of what we underwrote. And so what felt like an expensive construction proposal now feels like a bargain. And this is how quickly these markets are moving today. And really, I think a great example of why you want to be in real estate. This is where the inflation is happening. And if you want to fight inflation, you have to be in hard assets. And if we go back to 1973 and look at a market that was maybe similar to today, what you take out of that time period is that public REITs, the best proxy for real estate, private real estate, they outperformed over the next several years. And in order to fight inflation, you want to be in inflationary assets. And that is about being in real estate. Let me go to the next slide, please. This is the fund's performance. And over the last 12 months, the fund has generated a 22% year-over-year return. And we've achieved positive returns in 36 out of the last 37 months. Our only write down was in March of 2020. You can see it there. We wrote it down by about minus 6.9%, but then it's done nothing but gone up since that time period. And so the fund, it's doing really well this year. Through the first 4 months, the fund has generated a 4.3% total return. And we're on track to deliver around 11 to 13% throughout the entire year. So that's slightly above our target return in this fund of 9 to 11%. So things are going very well right now. Let's go to the next slide, please. So here is a quick snapshot of the portfolio. As of the end of April, the net asset value stood at $270 million. We have 18 assets in the fund. If you're a current investor, you're going to get this email in the next couple of days. The unit price was written up slightly to $11.22, so about 6 cents from the previous month as well. The leverage ratio is low here, 53%. We target generally 65% when we build a property, when we acquire a property, but generally you're going to see that go down because as properties appreciate, you can't hold that leverage constant. You can only get to that 65% leverage mark when you buy a property or refinance a property. So you'll always see, this fund or generally below that 65% leverage ratio. The fund's current distribution yield is around 5.6%. I know we got a lot of questions about this as well. And I'll just say, some of you may not know this, but we increased the yield at the beginning of this year by about 5%. And our goal is to increase it every year. We'd love nothing more than to have this fund be a dividend aristocrat. That's sort of one of our internal goals, is to continue to increase that every year. We target 5 to 7% that yield. 6% is sort of that magic bogey. But if the unit price continues to rise, that's going to fall within a given year, and then we'll readjust that at the end of the year when we increase the distribution rate, as long as we think we can hold that consistent. Now, if you're a new investor, just let you know that we do have a DRIP option. You can elect to opt into that, reinvest those dividends if you don't need income. And certainly if you're a current investor, you can always turn that off and elect to take the cash or turn it on if you don't need the cash. Let me jump to the last slide that I am going to go over here. And this is really the best guidance I can give you about the fund. And we created some stress tests and a downside and upside, kind of a base case scenario. And the stress test, which I'll talk about first, this is a world where our development projects make no money, zero money. And those projects generally are underwritten to about a 30 to 35% return on cost. The information we have is they're actually doing much better than that. I gave Linden House as an example. In this scenario, our common equity portfolio makes no money either over the next year, 2 years, 3 years. And our preferred equity position performs as expected because those are very well insulated. And in this case, the return to the fund is still positive at 6.25%. I personally think this is a pretty draconian scenario. I don't think this is going to happen based on the information we have today. The upside scenario, it assumes we generate a 3x return on our development, and the core generates a 10% annual return, and the preferred equity performs as expected. Well, to me, like that is likely or equally could be our base case scenario where we sit here today. And you see that this ends up in a 14% return. And I think, you know, to get 3x in some of our deals where they're located with the preliminary information we've had is realistic, right? It's not completely unlikely. So when I'm drawing sort of probabilities around this, I think the upside has much higher probability than the downside case here. And the base case really sits between the two scenarios and achieves, you know, sort of a 10% or more return, and that's what we generally target and you know, strive for in this fund. Again, the variance around all these scenarios, there's not a huge deviance, if you will. It is small because 60% of the portfolio is in or committed to preferred equity, and that provides the stability in the fund, the stability we are trying to achieve. And the ground up development sleeve is what I'll call the jet fuel for this fund. And that's going to help us outperform on the side and really achieve the alpha that you all pay us for, not only in the portfolio construction and making sure that our downside is protected, but also that we're capturing the upside as well. The last thing I'll say about this, because we get this question, our IR team feels this question, well, I'm going to wait. And everybody sees what's going on in the stock market, and they expect the same thing to happen in this fund as well, that things will come down and they'll opportunistically buy. And I'll just tell you right now that if you are waiting for the unit price in this fund to drop before investing, you are going to be waiting for a long time. I don't believe that's going to happen this year, next year. I think this fund is really, really well positioned to outperform in whatever market comes our way in the next 3, 6, 9, 12 months, 2 years. And we are going to continue to increase the unit price. Some months will be bigger than others, but over time, you're going to see that upward trajectory. So thank you very much. I'm going to hand this over to Dave now.
Thank you, Michael, and good morning, all. A lot of great intel is covered by Michael there. Let's jump right into our portfolio highlights. And afterwards, as Michael mentioned, I'll provide a brief overview of our current acquisition pipeline for fund investment opportunities, which includes about $152 million worth of potential equity deployment across 11 investments. And as Michael spent a good deal of time talking about, the general theme in our portfolio right now is strengthening of operating fundamentals across the board. It's happening in all of our markets, but in particular, we're enjoying these benefits at our individual investments. So the first one we're going to cover here is Monroe at Aberdeen. For those of you who have been following the portfolio for a while, know this is a 120-unit multifamily project built in 2018, located here in the West Loop neighborhood of Chicago. Over the course of the quarter, leasing velocity was pretty consistent, both at the property and also the submarket level, led to a very strong occupancy average over the course of the quarter of about 95%. And we, through that time frame, both the project and the submarket removed rent concessions, so there was really no offering of free rent for any leases that were executed at our project and again within the submarket. So that in and of itself is a strong indicator of strengthening market fundamentals. Occupancy over the quarter at the particular project here was 94. So as I mentioned, we were just a tick under the overall submarket at 95. Where we started to see some real strengthening at the property level itself as we outperformed our comp set on lease renewals. So we retained about 52% of our expiring leases at the project. And while doing so, we grew our effective rents by 26%. And it's important to note that, again, as we mentioned before, this was due to during a period of time in which we really aggressively reduced free rent concessions during the quarter. So we were able to grow our new lease rates over that time frame and averaging in total 13% on the renewal lease rate growth as well. Due to the outperformance in the renewals and as well as our efforts to increase parking and utility income, we were able to grow the overall revenue per square foot at the project almost 4% during the quarter, compared to a 2% increase by our comp set. So we almost doubled them up over the course of the quarter. And then to note, again, installing some new technology here at the project, we implemented the use of a new AI-based revenue management system at the project. And the intent there is to, again, drive aggressive rent growth while finding a way to maintaining our optimal occupancy and also helping to smooth out the lease expiration risk over the course of the year so that we can manage those expirations during the most optimal time during the leasing season. So that system pulls in a host of submarket dynamics and competitor information to adjust our pricing on a daily basis. The next project in the portfolio that we'll cover here is Madison at Westinghouse. Again, to give a point of reference, this is a 250 unit project located in the Georgetown submarket, which is north of downtown Austin. This has been, for those of you who've tuned into prior webinars, this has been the absolute all-star performer for our portfolio for the past year. It was really one of the projects, if you were to break down, submarkets that benefited COVID and the immigration trends as a result over the last 18 months, this specific submarket certainly would lead the way in terms of its performance nationally. So the leasing, that said, over the quarter was relatively flat in terms of overall velocity, but we've been able to maintain a pretty strong occupancy as we consistently maintain occupancies somewhere in the 96 to 97% range. We're starting to see a little bit of supply threats creep into the market, which again is a natural phenomenon you'd expect to see given strong submarket fundamentals. Other developers are taking note of this strength and are trying to find ways to add additional supply to this submarket. We are protected somewhat with some barriers to entry here, given that the Georgetown planning department is trying to limit the number of new multifamily development projects. But we were impacted by the delivery of a project about a mile away during the quarter. So they were starting to offer 1 month free of concessions during their lease up. So we were starting to see some real competition from them. And we did lose some prospects that we would have otherwise converted previously had that project been brought online. We also do, in addition to this project, we do anticipate we'll see another project come online towards the end of this year that likely will place some pressure on rent growth, as you would likely see additional concessions being offered in the market, similar to the comp that I just mentioned. We did maintain a pretty strong occupancy in the quarter at around 96%. So we bested our comp set by about 2%. And again, as we mentioned in past quarters, the average new lease trade out here was about 23%, and our increase in our renewals was 19%. So that we exceeded our comp set by about 2% and 5% respectively. And however, because we were pushing rents so aggressively here, we did lag our competition by about 11% in terms of our renewal rate. But we will backfill that vacancy as evidenced by the occupancy that we've seen throughout the quarter. Similar to the Monroe story, we're implementing some value add initiatives at this project as well. We're looking at rolling out 4 electric vehicle charging stations in the first quarter. And then we're also installing a new smart access system with smart thermostats to all of our units and amenities during the second quarter here. Lastly, we're also implementing some exterior painting initiatives over the second and third quarters as we look to enhance our curb appeal. And also some of this is frankly being done in defensive nature because we know our newer competitive set will have these offerings. So we're making sure that we're keeping pace with new projects that are in the market. Lastly, we'll cover our third common equity asset, which is the District and Memorial Project. Again, some context, this is a 326 unit structure park deal located in the infill Memorial submarket of West Houston. The fundamentals of this submarket were not quite as strong as certainly the ones that we just mentioned with Monroe and then the Madison project up in Georgetown. But if you follow the progress of the operational performance of the submarket from COVID, we're sitting much, much better than we were in, call it, August and September of 2020. So over the quarter, the property itself maintained a 92% occupancy, just a hair below the submarket average of about 93%. But we've implemented a number of strategic new leasing initiatives here and also spend a lot of time focusing on retention of our residents here. And overall, we were able to increase rents above our competition by about 2%. Retention here was about 43% over the quarter, relative to our competitors of about 51. So despite the fact, and this is a pretty common theme as you're hearing here, we are getting aggressive on our renewal trade out leases here by trying to push rates there at 6%. So it's a balance between pushing rates on your renewals, pushing rates on your new rents, retaining those residents and boosting occupancy. So we're trying to find that optimal range, certainly here, but also in all of our projects. One thing to note here is that in March of this year, we experienced the highest traffic count that we've seen since July of 21. And we believe that'll continue through the leasing season here, the strength of the leasing season here, which is kind of May through July, and we'll continue to boost occupancy and push rents along the way. Last thing to mention about a COVID throwback here, rent collections here have remained strong. We collected about 97% of our billed rents at the end of the quarter. Just to give you some context where that was in the teeth of COVID, that was roughly in the high 80% range. So significant increase. And as we expect, as we continue to see the submarket trend upwards, we believe that collection rate will get upwards of 98, 99%. On the next slide, what we're going to do here is we're going to cover Horizon at Sereno, and this is effectively a case study of our build-to-core portfolio. And we have 5 such of these assets that fit this profile. And as Michael mentioned, and he used a great line in terms of these being the jet fuel for the broader portfolio, and that's exactly what this is. The investment performance metrics of a development project will help to boost the stable underlying performance of our preferred equity portfolio. And the basis that we have on these investments, and we'll talk a little bit about, again, the benefits of our pref and the insulation that those have, even if the market were to retreat a little bit, the basis in all these build-to-core assets, which represent in some cases pricing on land or construction pricing that was locked in several months ago, provides a lot of protection in the event that we do see a correction. And I'll give you for example. So just to paint a broad brush, the basis for most of our build-to-core of these 5 assets is somewhere in the neighborhood of $220,000 to $230,000 a unit. That's an all-in development basis. And we underwrote exiting the portfolio on our initial base case underwriting at around $260,000 to $270,000 per door, to give you a kind of a rough range. And based on where we're seeing current trades in the market today, we're seeing asset trades somewhere in the neighborhood of $350,000 a unit. So if you just take rough math and keep it simple, $350,000 a door, a 20% price correction, that's $70,000 a unit. 70 minus 350, you're still at $280 a door. My point being is that we're actually, even if the market does correct from where we underwrote, and we underwrote these projects achieving a mid to high teens IRR, we're still in great shape. As Michael mentioned before, we don't anticipate a market correction to occur at that level. But the point I'm trying to make here is that if we do see it, and this is why Michael mentioned that if you're waiting for our unit price to come down, you're going to be waiting for a long time, because even if the correction occurs, we're still achieving our baseline underwritten rents for this portion of the portfolio. So Horizon at Sereno, just to spend a little bit of time on this project itself. It's a 320 unit Class A project that is located in Wamama, which is a suburb, south suburb of Tampa, Florida, located down Hillsborough County. This project's one of the last undeveloped sites in a master plan community. It'll span about 17 acres in total with 7 buildings. We're going to have a Class A finishes throughout in terms of the fitness center, the saltwater pool, resort style pool, the indoor and outdoor dog spa. And then we're constructing a barn here to store golf carts that can be used by the residents to access the nearby retail amenities. And similar to the story that Michael told about Linden House, we closed on the land here in this project in April, so almost 30 days ago, and we expect to break ground in June. And originally, when we were underwriting this project, we were anticipating breaking ground in, call it roughly October, November of last year. And there was a significant delay caused by the local school board, as they were not passing any of the permits because they were worried about capacity issues from all the other residential that both for rent and for sale that was being proposed in the area. So there was a significant holdup from our groundbreaking. And as we all know, what happened in that period of time, well, construction prices continued to increase. And what happened was, same story as Linden House that Michael just alluded to. What happened in this submarket over that time frame is that we saw almost a 20% increase in rents. So now submarket rents, which we underwrote, that's about $1,600 for this project 7 months ago or so, are now, we can comp out in the $1,800 to almost $1,900 range for our comp set. So a great story about how much conviction we here at Origin have in this project. We passed around the hat to cover some of these construction overruns here within Origin amongst the employees. And what we did is we do what we do on every investment, is we resurveyed the market. We saw how much appreciation this asset has recognized just through rent growth alone. I haven't even touched on the fact that our land basis in this project, which we had tied up almost a year ago at this point, reflected a land basis from a long ago where you've seen an increase of 50 to 100% on land trades in the submarket since then. So if you look at what happened with the rent increases of 20% plus our increase in our land basis, that translates into almost a $20 million increase in the valuation once this project is stabilized. So this ended up being the quickest internal Origin employee raise and most significant investment made by Origin employees for a single deal in our firm's history. So that's a testament to the belief that we have in this project. On the next slide here, we're going to cover very quickly. I know we're kind of getting long on time, so I'll try and cover this quickly. But similar to the Horizon example, what we're going to do here is use this lively upstate portfolio as a case study for our broader pref equity portfolio. And as we've been saying for the last number of months and a number of webinars, preferred equity remains to be seen from what we see, is the best risk-adjusted return in the marketplace. And this particular portfolio of deals, which we acquired or closed on in a variety of timelines, really in kind of late 20 and early 21, these are 3 deals that are located in and around Greenville, South Carolina MSA. And they're structured in a partnership with a vertically integrated, meaning our development partner has its own internal general contracting company, vertically integrated partner that's based in and around Greenville. And the structure here is very compelling in that we've secured tax credits that effectively collateralize our entire position. So those tax credits are realized upon completion of the project, which we anticipate that completion to occur in the coming months. So we love the fact that they're structuring here, in the value of those tax abatements, that effectively, once the project's built, that would cover the takeout of our entire position plus our accrued preferred return. But what I want to highlight here, in addition to that benefit for these particular deals, is something that's similar to every single one of our preferred equity investments. So if you look at the capital stack example on the right, you can see that where we sit within a traditional capital stack for our preferred equity investments is between the senior debt and common equity. And so in terms of priority, the senior debt gets repaid their investment back first, their capital back first. We will get paid back our capital second. And if you look at the loan to cost numbers that are on the left-hand side of each one of those projects, when we originally structured these deals, we sat between roughly 65 and 80% of the loan to cost. So 65 was the senior, 80% of cost was our last dollar at risk. And then the common equity filled in the tranches above that. So that roughly 20% of the capital stack was in a first loss position. We would get our return and our capital back before they even see a dollar of return of their capital or profit. Importantly to note, on the right-hand side of this range, as you can see, is that now we're seeing, because of where these projects sit in terms of their completion, where the market has gone is on average, based on today's value, we're sitting at about 60%. So to kind of rewind that back, the senior loan, when we originally developed these projects, were at 65. Now they were getting paid about a 4% interest rate. We are collecting a 13.5% compound annual coupon. And again, you can see how much risk has been removed from, or said differently, how much value accretion has occurred and how protected this position is from where current value sits today. So to be sitting at 60% of value and collecting a 13.5 coupon, we're pretty excited about that. Last slide, I believe, for me to cover is to run through our deal pipeline, which, as I mentioned before, we've got 11 projects that are in our pipeline, representing about 152 million worth of total equity commitments. And as you can see, geographically, we're spread pretty well around the country. There are a couple of pins that will get added even further southwest. Tom Briney is making some great inroads in terms of our efforts into Phoenix. So we'll continue to push westward. But as you can see, a great cross section of diversification across the country and the Sun Belt in particular on where these, and then I think there's one pinprick that should be on here in Denver, which we just received word, I think this week, that the deal's coming our way. So one thing I just wanted to highlight in terms of one project that's closing this week. Selfishly, it's one of my projects located in Asheville, North Carolina. So about 2 hours north and west of Charlotte, located in West Asheville. So it's about a mile from the retail and entertainment district. So walkable, great fundamentals for this submarket. We have an outstanding partner here in Charlotte that will be developing this project. And another, to build out the story of protection in pref, our basis on this project is about $230,000 a unit. Comps trades that we're seeing in real time in Asheville, that every bit would be a competitor to this project, are now averaging somewhere close to $380,000 to $400,000 a door. So significant basis protection in this investment. But again, that's no different than any single one of our projects that we have in the portfolio. So Michael, I think with 10 minutes left, I'm going to kick it back to you.
Oh, let me fix my camera.
And while you're fixing the camera, I can start queuing up some of the Q&A here that we're gonna jump to as well.
Yeah, we're going to do that. And just as a reminder, everybody, if you have questions, please submit them into the Q&A box on that side, and we'll get to those. And we had a lot of questions emailed in prior, and we've sort of, I think, answered quite a few of those, and we'll just jump into those first, and then we'll get to the ones in the Q&A box. So Dave, if you want to take a little break, grab some water, I really loved your part of the presentation about the Lively portfolio. That's why we're so excited about preferred equity, is when you believe in projects and you're investing with good sponsors and they create value, you're going into these positions where you're just getting paid outsized returns for the risk that you're in during that. So love that story. So the first question I'm going to answer, this came in a few different ways, is how often is the net asset value adjusted, and what formula is used to determine the net asset value, the NAV? And then there was a question about subsequent about how we value ground up development projects. So there is a formula that we use, and I'll go over this. The NAV is adjusted on a monthly basis because investors come in on a monthly basis. On the first of the month is when you get a trade date. So if you invested today, committed, sent your money in on June 1st, you would actually be entering into the fund when you're entering in May. And so we have to do that on a monthly basis. And the way the net asset value is calculated is we take the preferred equity, we value those at book, which is basically the price we pay plus any accrued interest, and that becomes the value of those. And then the common equity assets are done on an internal basis on a monthly, and we write those up as needed. Those also produce cash flow, so that's creating more to the NAV. We take out expenses as well from that. And then on the development portfolio, it's a little bit complex, but the general idea is that from 0 to 50% of construction, we are discounting that back. We look at a point in time in the future when that portfolio is stabilized, and we say, okay, here's what the property is going to be worth in 3 years from now. Well, the further you are out to that point in time, the higher you have to discount that because your risk is higher. So from 0 to 50% of construction, we're using about 1,000 basis points above the prevailing discount rates in the market for core assets. So you're adjusting for that risk. And then when it goes to beyond 50%, then we bring it down to 800, because every dollar you put into the project and you get closer to that cash flow, you're actually reducing the risk. So the first dollar you put into a project is far more risky than the last dollar or when you're renting up a project. And so your required rate of return or your discount rate continues to shrink over time. So Mark Turner handles this. He's really good at doing this. And all of these development deals they follow the same methodology. And what's interesting, discounted at that very high discount rate. So investors who are in the fund or coming in the fund, will get the benefit. So that's it. And then I should add that on an annual basis, we are required, there's an audit in the fund, and then we're also required to get an appraisal on 1/3 of the assets as well, as sort of a spot check for our internal valuations. And the internal valuation methodology has been approved by the auditors as well. And that's something that they look at. So that's how the NAV is calculated and how often, and the way that we handle our ground up development projects.
Michael, you want me to tackle a couple?
Yeah, please. We'll just alternate here.
Sounds good. So seemingly simple question, complex answer, as the case with a lot of these, but which markets are most susceptible to becoming overbuilt? And so really that's kind of a two-part question. That's a supply and a demand question. So you can see a lot of markets, and I'm sitting here in Charlotte, and we have led the country in terms of percentage of increase of our existing stock, meaning we have a largest pipeline relative to the existing number of units in the country. And that's been for 5 to 6 years that phenomenon's existed. But what's happened over that time frame is that demand has not only continued to keep pace with the supply, it's actually outstripped it, which has led to very consistent 3 to 5% annualized average rent growth. So we have to look at number of units that are coming online, but also the supply the demand that would then come with it. And as we know, COVID has created, especially in the markets that we focus in, primarily in the Sun Belt and the mountain regions, there's been a huge influx of demand from folks that have relocated here. Michael touched on this a little bit. So if you're asking, generally speaking, which submarkets are susceptible to overbuilding, I would say there's some risk into the gateway markets, the DCs, the LAs, the New Yorks, and over time, because we are stealing in our markets a lot of the demand set that would have existed there. So I would say those markets probably are most susceptible to becoming overbuilt. Our markets, from what we're tracking and based upon our AI data that we feed into our machine and evaluate on a daily and monthly basis, have really strong demand fundamentals. So of our markets that we're looking at, where is the biggest risk that we see? Possibly Houston would be maybe the market that we're looking at. But Houston's a massive 8 million person MSA. There's pockets within Houston that will perform well, and those are the areas that we study. So long answer to a seemingly simple question, but we feel very bullish about the fundamentals of our markets that we've chosen.
Thanks, Dave. Next question. Should this be held inside or outside a qualified retirement plan? I would suggest that if you have 2 buckets of capital, that this be held outside, because this fund is meant to be tax efficient. Real estate is already tax efficient. So to me, qualified retirement plans should be in tax inefficient assets. But certainly we have a lot of people who actually come in through their IRAs because it just happens to be where their money is located and they don't have 2 buckets of capital. The next question I'll tackle quickly here is how many sidecar opportunities will be available this year and when? We actually have a sidecar opportunity right now in Jacksonville that we are syndicating. It's not really part of this fund, it's a standalone. This fund is already exposed to Jacksonville. Our Growth Fund 4 is exposed to Jacksonville. This was a great deal, one that was too good to pass up. And we know that people love these individual deals. So that is one that the business development team and the IR is going out to investors with right now. So if you have an interest in allocating more money, please reach out to your dedicated investor relations contact. And I will tell you, if you're new to Origin or you're not an investor, these sidecars, these syndications are only for existing investors. That's how you get access to them. We generally have an insatiable amount of demand internally for these, and so don't have a reason to bring them out. And these are just perks for existing investors.
I'll go ahead and tackle a couple, Michael. So what is the difference between growth fund and income plus fund? Michael touched on this a little bit, but one of the person who asked the question answered the question somewhat and said, is growth fund is focused on all development? The answer is yes. As we touched on before, we have a development allocation for this fund. That is our 20% build to core allocation, which is nearly full at this point. Although as the fund continues to grow, that 20% allocations allotment will increase. So we will be able to do new development deals within the fund. The other difference between growth fund and income plus is that growth fund's a closed-ended fund with some open-ended features to it. This is an open-ended fund, evergreen REIT structure. So there's some differences in the structure, but the strategies are, yes, no pref, all development in growth fund. Do you manage, property manages the assets once they're stabilized? The answer is no. We do not have an internal property management function. We don't anticipate having one anytime soon. So that's a quick no. And then I'll hit one more, Michael, if you're all right with it, so I can clean a few more of these up. Projected growth rates for multifamily housing going forward. What markets offer the best opportunity right now? Michael touched on this earlier. We are seeing, frankly, unprecedented rent growth across the board for multifamily rent appreciation for 2021 and even through the first quarter of 2022. We have a proprietary AI model that suggests we're going to see quite strong growth for the balance of this year and into 23. And then we start to see kind of the middle part or latter part of next year, some deceleration of rent growth. But mind you, this is coming off of unprecedentedly high rent growth of 20 to 23%. So even if there is some deceleration, we still see that being stronger than historical norms. Markets for the best opportunity right now. We just did a markets webinar about 2 weeks ago. I would highly advise or suggest you go take a look at the recording for that webinar where we highlighted where we think the best markets are. But to give you a couple, Phoenix and Las Vegas, we highlighted Tucson and Nashville.
Dave, I'll grab 2 questions and then we'll go to the live Q&A unless you have more. Do you do cost segregation analysis on purchases for this fund? And the answer to that is yes. And that is the advantage of holding assets for the long term, is that you can accelerate depreciation and actually take the advantage of that. When you do it in a buy, fix, and flip model, you do cost segregation, it's very negligible because you're actually paying on that excess depreciation, you pay normal rates on that, on the recapture. So you're not actually getting it. But in a fund like this, one of the big things is to be tax efficient, right? One of the goals. And we do that by providing as much depreciation as we can with our common equity assets. And that really offsets what I'll call the part of the portfolio that is a little less tax efficient, which is the preferred equity. But even in that, the way we have structured the preferred equity is that it's not considered a debt product per the IRS rules because it has no maturity date. So when we are in a preferred equity deal for 2, 3, 4 years, we're actually getting the benefit of long-term capital gains in that. So great question, and we do that. The other question that I'll answer before going to live Q&A, is there a single annual K1 or one per investment or state? There's a single annual K1, and this fund has a REIT blocker. So it actually it doesn't produce UBTI or anything of that nature. It's very friendly. We have a K1, or not, I'm sorry, an LLC on top of it because the LLC creates more flexibility for us, where a lot of times the REIT is rigid, but it actually creates tax advantages to a fund like this. Dave, you have any questions remaining on the ones that were emailed in, and then we'll jump to these?
No, and I noted there was 1 or 2 in the questions that came in beforehand that are actually appearing on the live Q&A. So I can jump into one real quick, Michael, which is it's a good question from Isa regarding the ground up strategy relative to buying existing properties to rehab. Seemingly a simple question there, but again, one that we've been studying for a long time. Our predecessor funds and even this fund have the ability to acquire and value add investment properties. And around 2017, 2018, we started to see the valuation for value add projects that we would otherwise rehab to compete with newly built projects. We're trading pretty close to, once you've baked in the entire cost of your rehab, to the cost to build new. So, and it's a broad brush statement, but in a lot of our markets, you were buying a late 80s, early 90s vintage asset that had some functional obsolescence. And by the time you were done, trying to modernize the unit interiors and common areas, you were pretty close to the cost to build new. And that's a scary proposition to us. We would much rather take on the risk to go build a new asset and have fully modernized, up to date for a very similar basis. And now we're seeing in a lot of our markets, those value add projects, including the cost of rehab, trade above replacement cost. So to us, this became very clear that we should be participating in this segment. And we talked about the insulation that you have on your development basis relative to stabilized trades. That's another reason as to why we think fundamentals will return, where maybe pricing is more in balance over time. But right now we're getting paid outsized returns for the risk we're taking to build ground up.
Yeah, Isa, that's a great question. And I'm just going to add, we've been out of the market for value add core plus for a while because of what Dave's talking about, sort of the distortion. And it maybe is counterintuitive to think that ground up development is a defensive strategy. But real estate starts with, yes, location, being in the right markets in the right place, but it also is about basis, how you're getting into the market. And there's no way to protect your basis by buying existing. We're seeing 20, 30-year-old properties trade above replacement cost. They work on Excel, but they will not work over the long run. And so, like, we really want to be cognizant and be looking at the horizon and be positioning this fund the best we can today. And that's by being in the right markets and protecting our basis. And the only way we see doing that is through ground development. So there's always exceptions to the rule, but generally you won't see us buying core plus or value add in today's market because we just don't believe that it's a good risk adjusted return. Dave, I'm going to answer this question from Sydney. Sydney, thank you again. You always ask great questions on this. There were questions that were emailed in about Monroe, Aberdeen as well, Chicago, our outlook. And I'll say that there, Chicago is an interesting market, and I would say it's a contrarian market. We live here, and we understand it, and we see it. And with Monroe, Aberdeen, there's a few things to understand. Number one, it's only 7% of the entire portfolio, so it's not as if we have a huge risk in this single asset. Number two, that asset actually has a lot of value left to create. Remember, when we got into that asset, we had above market debt. We're actually paying, even as interest rates have gone up today, we assumed a higher market rate debt when we bought that project because the former owners locked in 2018 at the height of the market. So our rate there is 4.3%. Today, we could probably refinance that at 3.8. The cost of defeasing that debt, though, is very expensive. On top of that, we have parking that we're starting to charge for. So idiosyncratically, right, the markets matter, but also the value that you're able to create and the information you're getting out of the asset equally matters in those situations. So while we're not buying assets here today, I don't actually mind holding this and having a bit of a contrarian play, because as much as, like, we can tell you that Phoenix is going to grow in these other markets. Well, one of the things that we're not talking about is what happens when California and Phoenix run out of water. That could happen. Chicago's greatest asset is the lake. Don't we want to be exposed to water and these natural resources and, a city that has more connectivity than any city in the country? So there's a lot of reasons to not be here. There are a lot of reasons to be here as well. I think that we bought that property right. It's in the right submarket, and we have a lot of value to add. And candidly, this fund, and there was another question that came in about this, it's not a buy, fix, and sell. We're trying to make long-term decisions and construct a portfolio of assets that will grow over time. And Monroe, Aberdeen will grow over time. It will do well. It's not going to hurt this fund. Could there be better uses for that? Yes, but then you're going into a 1031 exchange, and it creates a lot of complications. And then we have to buy sort of, a core asset, and you can't 1031 exchange an existing property into a ground up development. It's not that easy. So that's why we're not, I would say Chicago is a hold market, maybe not a sell today, but we're certainly not doing more assets here, but it's a little bit of a contrarian play and just not, doesn't add that much exposure to the fund at all.
Michael, I can grab one.
Yep.
So this one's straightforward. Differentiation between this fund and the QOZ fund. The difference being is that the QOZ fund obviously takes advantage of locations that are designated as a qualified opportunity zone, which is we have very, very strict boundaries that we have to invest in. So we are relegated to very specific locations, each of our markets. The other difference is that this fund you can invest in without capital gains. So you can use non-generated gains to make your investment. Whereas in the QOZ fund, it's most efficient and beneficial to invest your capital gains that you've generated for tax deferral purposes and then for tax avoid or long-term tax benefits.
Yeah, I'm going to tackle two questions here. Marina asks, what are the going in cap rates of these properties? So Marina, We answer that somewhat just now, saying we're not actually buying core plus or value add in the market for the reasons mentioned. Cap rates today in the market, you pick it 3.25 to 3.75. Something like Chicago is 4.25, adjusting for risk in a northern market. So it's the reason why, like, if you're borrowing at 4%, you're not going to go out and buy a 3.5% cap rate property and pay the bank every month. And that's why we're not really in that market itself. So hopefully that answers your question. The next question is from Daryl. Daryl asks, is there a requirement for time of investment for the IPF? In other words, what is liquidity fund? Daryl, there is a time for investment. It's generally 5 years. There's a lockout the first year, and then there's a declining scale penalties. And we want people to think about getting into private real estate, not timing the market, but being in here for the long run as a part of your portfolio. So we generally like to say, like, have a 5-year time horizon. This isn't a place to park money. It's for long-term investors, but we do provide liquidity through a tender offer program after year 1 to anybody who wants to participate in it.
I'll take a quick one, Michael. Do state or local rent freeze directives pose a threat to investments in the future? Short answer is no. We are not investing in markets that have considerations for rent control. Predominantly that's New York, that's Portland, and I believe Minneapolis, St. Paul. I've heard some of those markets that have proposed rent freezes. So we are predominantly in the Sun Belt and mountain regions where that has not been discussed and is unlikely to occur. So no, we don't see that as a risk.
This question is from Anonymous. In an environment where money was cheap and interest rates low, how were you able to get such high preferred equity returns, right? Why wouldn't people go elsewhere? The answer to that really, it dates back to, well, 2 things. 2008, lenders just aren't willing to go above 65%. And for developers who want to use very little equity and they want to go up to 80, 85% of cost, they need to go to non-traditional lenders. So to occupy that space from 65 to 85, the market rate for that today is about 12, 12.5, 13% for those particular slugs. So that's how. And then you compounded that in the last couple of years with COVID, where a lot of lenders pulled out, people sort of put their hands in their pockets, they waited, which provided some great opportunities for a company like ours to enter into those contracts with developers and sponsors.
Isa asked another question: which fund is the best value for a new investor, growth versus income? I'm going to be a little bit selfish here and say it's both. We love your capital in both of our funds, and in all seriousness, I actually do think if you have the capital to spread around in building a proper allocation for a real estate portfolio, you should have exposure to both funds, both income, for all the reasons we've spent talking for the past hour. The benefits of this fund, it's a protection and conservative place to park your money and get real estate exposure, and growth will give you higher risk but higher returns. So in no different than a common equity portfolio, you should have exposure to both.
I'm going to grab 2 questions. The first one is from Anonymous. When do you expect the dividend to catch up to the 6% projected yield on NAV? So the dividend yield is a function. We actually target a dividend per unit, which right now is 5.25 cents. And as the unit price goes up, the dividend or the distribution yield is going to go down. Our range for that is 5 to 7%. And every year we will continue to adjust that. So 6% isn't a magic number. We're still within the range of 5 to 7%. We're at 5.6% today. And you will see another adjustment coming at the end of this year up, and we'll try to get it as close as we can to that 6% range, but that's constantly fluctuating. And it's really just a matter of planning and preparing and making sure that we can afford, or the fund can afford through cash flow, to pay the liability of that cash flow as well. The next question is from Roger. Roger, thank you for your question. There was a mention of UBIT. Are there UBIT impacts if held in an IRA type account? No, and that's because of the REIT blocker. So you're absolutely fine if you want to hold this fund in an IRA.
So this one is pretty quick. Any pref deals that have current pay, are they all accrual? Predominantly, they are structured as accrual. I think we have one current pay portfolio or current pay asset in the portfolio. That is our Ashley Oaks investment down in San Antonio. But for the most part, these are all accrual.
Ryan and Bella had sort of the same question. If we're new to the fund, how long before capital will be deployed? If you invest this month, I think it's the 25th today, is it the 26th? Your capital will be eligible to go into the June 1st trade date, sorry. So that's, we call capital on a monthly basis. It's put into the queue doing that. So thank you for the question. And if you, for some reason, reach out to your dedicated investor relation contact if you're in the queue but haven't received a capital call yet.
Eric has a question on commenting on the fund's 2020 performance. I think the question is really asking, Michael, why was there some negative fund performance at that point in time in 2020? And I can answer it, and feel free to jump in on any additional thoughts you might have. But the short answer to this was we did write down the fund's performance in 2020. And frankly, we needed to a degree, because we had to acknowledge this is a mark-to-market fund through the NAV. We are always writing assets up to where the market is, or in the case of 2020, which was a multi-standard deviation event where asset values fell over that period of time. We did reflect the market at that point in time. So we did write the fund's NAV down, but then we took on a number of months, a number of quarters of write-ups thereafter, as we saw market fundamentals strengthening. So that's really the reason, was we reflected market fundamentals in mid 2020.
All right, Dave, I'm going to take the next one more question. You take one more, and then I'll sign us off. Okay. There is a question here. Very simple one. What is the expected income on 100,000 each year over the next 4 years without including appreciation? So you're asking about yield. The distribution yield today is 5.6%. So if on $100,000, it would be $5,600 per year. And that distribution yield you can expect it sort of to increase by 5% each year. So I don't know what the math is on that. So next year it'll be $5,900, then it'll be $6,200. So adding about $300 per year. That's how the yield is handled. And we're at about an hour and 15, Dave. So if you want to take the last question, and then I will sign us off.
Yeah, Jenny had a question on here regarding the difference between income plus and growth, which we just addressed. But the differences are, one's an evergreen open-ended REIT structure, the other one's a closed-ended structure. Income plus has focused on pref common equity positions and ground-up development, and growth fund is all development. So I think that we're fully out of questions, although I did see an anonymous one pop up here, which we'll try and tackle this one, because we're trying, we adhere to transparency here in fielding all the questions. So I believe an investment and growth fund means receiving a number of K1s, one from each state in which it invests. Is there a mechanism to only simplify, receive one K1 for growth fund? In the spirit of this being an income plus fund webinar, we will answer the growth fund question. I think the answer is no, Michael, because to do that, you do have to have the REIT blocker you mentioned, and therefore we cannot structure this to have one individual K1 for growth fund. Is that correct?
Yes, but it's nuanced. So we do allow people to have consolidated K1s when we can do that. So we do send out, you can elect to be in the consolidated form. And keep in mind that a lot of the states that we're in are zero tax states. So you actually don't have to file your K1 in zero tax states because there are no taxes due in those things. So in states that do have taxes, then you have to, and there could be a few in here, but we do a composite election in that. So thank you everybody for your time today. If your questions didn't get answered, please reach out to somebody in IR. You can get a hold of them via the website. I'm sure if you're a current investor, you know who your dedicated contact is. You can always email me, michael@origininvestments.com. I love to hear from investors. And I hope that we are able to convey, what's happening in the fund and how well we're positioned. And I think we feel really good, especially when we started this journey, not just back in 2009, but in COVID, saying we are going to position this fund to be defensive. And some of the things that we're seeing and those storm clouds on the horizon are starting to take shape. But I'm personally really excited about this. I have a lot of money invested in this fund. I know my partner does. Everybody in the company is in one way or another exposed to or benefits from the performance of this fund as well. So it's been a pleasure doing this webinar today. And again, if you have any further questions, please reach out to us. Thank you and enjoy the rest of your day.